looking at the liquidity risk score, we're neutral. Looking at leverage, we're kind of low, not even
Very.
neutral, we're pretty low, which is suggestive as we go through more of your work that, we've got a potentially larger move at play here because we've got very little headwinds.
Yeah, yeah. So it's exactly very little headwind. If the positioning was so one-sided at this point, especially around an all-time high, like we got in this one here back in Q1, this was pretty much level with the old 2021 high. So you had old resistance, but you also had far too much leverage and positioning all one way right at the top. So it was just it was a recipe for a pullback. We don't have that now. So it's just, it's very, very muted, which is great to see.
Bitcoin is trading near its all-time highs, but the market dynamics beneath the surface are very different from the frenzied peaks of 2017 and 2021. There's no meme-fueled mania, no crowded leverage, and no overwhelming retail euphoria. Instead, we're seeing a disciplined rally characterized by low leverage, muted positioning, and very little of the typical froth that signals a cycle top. This unusual behavior is catching the attention of macro analysts like Raoul and Jamie Coutts, who see it as a sign of a longer, more sustained crypto cycle, one that could extend far beyond what most investors currently anticipate. Unlike previous bull runs that burned hot and fast, this cycle is unfolding under vastly different conditions. Sovereign wealth funds in the Middle East are increasing their adoption, not just of Bitcoin as a reserve asset but also blockchain infrastructure at a national level. At the same time, global liquidity, a key driver of macro asset prices, is breaking out of a multi-year contraction, showing early signs of returning excess capital that could flow back into risk assets like crypto. This suggests a potential structural shift in crypto cycles, moving from short bursts of speculative frenzy to extended phases driven by institutional capital, technological integration, and macroeconomic alignment. Coming up, Raoul will share exclusive insights from meetings with sovereign investors in the Gulf region, while Jamie Coutts presents data illustrating how global liquidity influences Bitcoin's performance and why the current breakout might lead to a much bigger move than many expect. If you're tracking macro signals, following institutional flows, or trying to position ahead of the next major crypto leg up, this discussion is a must-watch. This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to portfolio, tap your Solana asset, then click close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
Fantastic. So there's a lot to dig into. And before we start, just observationally, I was out in the Middle East, last month, I think it was, and sitting down with the sovereign wealth funds. And the mandate across the entire region, from Saudi to Abu Dhabi to Dubai to Bahrain to Qatar, is AI and blockchain. And not just using Bitcoin as a reserve asset, but also building the entire government infrastructure on blockchain, driving licenses, property deeds, the whole bloody lot. So it's it's fascinating to see. And then a lot of people say to me, well, if all of this money's coming in from the sovereigns, that may produce an outside return. And I'm thinking, well, if we're going from 3 trillion to 100 trillion, which is my estimate by just extrapolating out the trend rate of growth, you need larger players each time because the market cap is bigger, right? There's no way you're going to get to 15 trillion this cycle unless you've got bigger players. So it's I don't think it's what people think it is. I think it's just a function of the size of the market. The bigger it becomes, the more that those people are involved, and the more blockchain technology gets used, the more it uses the alts for infrastructure rails, for new forms of compute and storage and all the other things that are coming. So I just thought it was interesting because everyone's like, oh my God, it's a super cycle because of this. I'm starting to err towards, well, we've talked about this before, a longer cycle, just because the business cycle is still below 50. So generally it takes a while to climb up. And then we use the GMI Financial Conditions Index, and that has a 9-month lead. And with the dollar breaking down, even today, it's starting to suggest that this may go even into Q2 2026. So it's like the whole cycle got shifted because rates didn't get adjusted and the dollar was sideways for a period of time. So it feels that potentially there is a chance, and again, there's no guarantees in this world, that we're more like 2020 than we are in 2021.
Yeah,
Or it's it's spookily similar to 2017 for me. So let's go through some of your charts, some of your framework, because I think people are going to love to see the work that you put in. I don't know where you want to start with that deck or whatever you think the best narrative are.
Well, I think we could sort of start with just the actual risk framework that I built, looking at global liquidity first. So what I've got here is just my version of global liquidity index, which is, aggregation of private credit through, global M2s, or the global money supplies of large countries, central bank balance sheets, FX reserves, US net liquidity. And
this is similar to our GMI total global liquidity. Yeah.
Yes, okay, it is. Yeah. Yeah. So what's your number roughly? Do you remember?
I don't know actually.
Yeah. Well, it's you can see that there's a very tight correlation, like depending on the data set you use, the regressions, the R squared, or the the explanatory factor of global liquidity on the Bitcoin price movement is very, very high. It's like one of the strongest relationships in financial markets.
Yeah, we get, using ours, we get 90%, 88%.
Yeah, and I'm in that ballpark as well. But what's interesting is that that's a relationship, that's a sort of linear relationship over the time period, but there are periods where Bitcoin becomes hypersensitive to the changes in liquidity. We've had these periods where, global liquidity goes sideways, and actually Bitcoin usually tops before global liquidity tops out. So it's
like when the rate of change of global liquidity slows down, it starts topping.
Yeah, because this has been driven by, in the past, a lot of central bank activity as well. So central banks move very, very slowly, but the market detects when when break-even starts to break high, the market starts pricing in higher inflation, that the central banks will have to pivot. But they don't pivot on a dime unless it's an emergency when they're adding liquidity, but never when they're withdrawing. So usually Bitcoin will sniff it out many months in advance, and we'll see the top form, and then global liquidity will roll over. But the contraction periods in global liquidity traditionally have only been sort of 24 months, so 2 years. And that was in 2014 and 15, then in 2018 and 19. The one that we've just gone through has actually been 3 years. So to your point earlier about the cycle being elongated, if you look at global liquidity here in white, it's been it was down sharply in 2022. And then we just had this sort of contraction period, like a wedge pattern that we've sort of been squeezing into and now breaking out of. So a longer contraction.
Buying that low in the first, that's what we did. And it worked really well. Back end of 2022, when global liquidity, it doesn't give the strongest price action, but I don't know, Bitcoin's up 6x since then. So it does work just by getting the bottom of it. But the breakout is when it really counts, right?
Yeah. So the tops are harder, but the bottoms are easier actually, because, at the bottom, it's usually sharp central bank actions. And that's the signal. You sort of don't have to sort of second guess that. And now that we're starting to break out, and you look at the sort of breakout of the last contraction period, and obviously 2020 was exceptional, so we're not looking to repeat that. But generally, if you look at the previous times we've gone out of a contraction period, that has been what I define as like the super bullish liquidity regime. So, global liquidity can only contract or go sideways for a certain amount of time because the whole system is so indebted that their default risk rises, and also just the interest cost on debt becomes too excessive. So there's always an impulse to add liquidity. And so like a beach ball under the water, if you keep it down for too long, it's going to burst out, and we're starting to break out now. And so in the past, when we've seen a breakout of the previous all-time high in global liquidity, Bitcoin's sensitivity to the changes in liquidity triple at least, sometimes 4 or 5x. So
wow.
in my analysis, global liquidity goes up by 1%, Bitcoin usually rises about 7%. But in these particular regimes, that goes to 20 to 30 times. So a multiplier of 5.
What Jamie Coutts is outlining here goes beyond a simple bullish case for Bitcoin. It's a fundamental reshaping of how macro liquidity cycles influence digital assets. The crucial insight is that global liquidity doesn't just support crypto prices. It's the most powerful factor driving Bitcoin's long-term directional move. Right now, liquidity is breaking out after the longest contraction in over a decade, which historically signals the start of Bitcoin's most aggressive price rallies. This time, the setup is even stronger. The market has already weathered years of tightening and higher interest rates, emerging from contraction with far less speculative excess than before. This mix of low leverage and a strong liquidity impulse sets the stage for sustained, outsized returns. Importantly, Bitcoin's price bottoms have historically aligned with central bank pivots and liquidity injections, just as seen at the end of 2022, and that same pattern seems to be happening again now. In other words, we're not late to the party. We're early. Coutts calls this phase a super bullish liquidity regime, where Bitcoin becomes extremely sensitive to liquidity flows. In previous cycles, this regime amplified Bitcoin's price moves by 3, 5, or even 7 times. So even a modest increase in liquidity could lead to exponential gains in crypto market. And that's before considering the sovereign adoption wave Raoul discussed earlier. Let's dive back into the video.
What's really interesting is that we got the breakout in global liquidity in early April as the markets were sort of tanking. So that was this low that we went through, which really wasn't much to worry about, like in terms of Bitcoin pullbacks, but it felt pretty nasty at the time. Massively outperformed the S&P, massively outperformed the equities on a volatility adjusted basis, even though, it was down 30% and the S&P was down 20%. On a risk adjusted basis, massively outperformed equities. And so when global liquidity broke out in early April, Bitcoin rallied 40%. Global liquidity from that breakout is up about 2%. That's roughly what it has done in those previous bullish regimes where global liquidity breaks out to new all-time highs. You get a sensitivity factor that is factors higher than it typically is. And so for me, it's interesting that, we're not overbought, based on liquidity. Every new dollar that's created, whether it's even through like the US dollar weakening or depreciating, is an easing on financial conditions. It all adds liquidity into the system or makes financial conditions better, and the relationship is strong. And so, I'm looking at now a market that is not overheated at all. In fact, it's doing what it should be doing and it's not doing anything excessive. So I talked about a framework for sort of modeling the risk. What I did was I converted that relationship into a risk score. And the risk score for global liquidity is just this one here. It correlates pretty well to the tops in Bitcoin. So what you want to see, it's a rating system of 1 to 5, but I've also got percentiles, and we'll be publishing them onto the RV platform. So if people want to get a little bit more granular, like if we're at a 4, does that mean we're at 82nd percentile or the 88th percentile, the 90th percentile? We'll get that granularity shown as well. But what it's designed to do is to say, okay, anything below a 4 is sort of just neutral, normal conditions. When we're at 4s, you have to start thinking about, okay, if there is chips to be taken off the table in Bitcoin or crypto.
And this is not necessarily the full cycle top. It can be sub-cycles within, right? Because I'm looking at got to 5s a couple of times, backs off again. So you kind of use it like a weekly RSI kind of idea, is like an overbought, oversold indicator.
Yeah. So what you said is like perfectly correct. It's like you've got to use it with some context. Like an overbought RSI at the beginning of a breakout of a long-term downtrend is not a sell signal, it's a buy signal. But this is a little bit more calibrated to knowing when things are really stretched relative to the one the one statistical relationship which really seems to matter, which is liquidity. So if it becomes extremely stretched versus liquidity, even in a mid-cycle scenario like we saw in early 2024, so we got that read when Bitcoin was around 51, 52,000. It topped, within a week or two at sort of 73,000. So it doesn't catch the top. None of these are going to catch the top, but it tells you when global liquidity, when the price is stretched versus global liquidity. And of course that's
how I think about this to explain to people is call it a 90% correlation roughly. It's when you look at what's the other 10%, it's often the fear and greed, the elements where the market gets over ahead of itself, which is what you're picking up here, is like the deviation from the trend. versus liquidity, right?
Yeah.
So when it gets too obscene, people have taken too much risk. And then you've got other scores like leverage that then you would add on to that and say, yeah, and the leverage is built up and that's why we're in excess.
Yeah, exactly. So like, I probably should have said this from the outset. It's global liquidity, it's leverage and positioning, and it's unrealized profit.
It's broader than just deviation from liquidity.
Yeah. And that's important because that tells the other side of the story. So, okay, you can say that, okay, it's stretched in terms of where it is relative to global liquidity, but is there excessive leverage in the market? Like, if that is also happening at that time, boy, oh boy, do you have a very strong signal for a looming market top, because derivative, like open interest and the factors that go into the leverage component of the derivatives risk score are very finely tuned to tops and also bottoms. So that plus also unrealized profit, which you can see on chain, come together in a very good way, like in terms of the confluence that you can get from it to give you sort of high probability zones of when things will top and bottom as well. So this was indicating, that in the early part of 2024, just a couple of weeks before we had that top, which I'll show you with the next chart on the derivatives one, was really driven by the derivatives market. Just where it was so excessive in Q1 with the launch of the ETFs that it was destined to correct. It only corrected by 25-30%, a pretty normal correction, but it did take about 6 to 7 months to unwind all that positioning. And then we also got an overvaluation read on the global liquidity risk score in December as well. And if you remember back then, you were talking about it, I was talking about it, like dollar was strengthening, like liquidity was tightening as we rallied very, very sharply into Christmas. And of course, then we had the fallout for the next sort of 3 or 4 months. So now where are we? We're at a score of 3. We are neutral. There is sort of that 40% rally off the lows of April is just the normal, the normal relationship playing out.
What Jamie Coutts has created isn't just a model, it's a comprehensive framework for navigating market volatility with discipline. By transforming global liquidity trends into a dynamic risk score and combining that with data on leverage, positioning, and unrealized profits, he's built a real-time dashboard for timing market cycles. Right now, that dashboard is signaling green. Global liquidity is expanding, leverage remains low, positioning is balanced, and despite a 40% rally since April lows, Bitcoin's price action is still firmly tied to broader macro conditions. The key takeaway is that market tops don't simply happen because prices are high, they form when conditions become stretched beyond what liquidity can support. That's not the case today. In fact, the current environment looks unusually healthy compared to past peaks, including the Q1 surge around ETF launches. If this momentum holds without a surge in leverage or excessive speculation, we could be witnessing the start of a fundamentally different kind of cycle, one driven less by hype and more by capital flows, macroeconomic factors, and growing institutional maturity. If you found this breakdown helpful, be sure to like, subscribe, and turn on notifications so you won't miss our next deep dive into the macro to crypto landscape. And let us know in the comments, do you think we're in the early stages of a longer crypto cycle, or is this just another market head fake? We'd love to hear your thoughts on where the charts and liquidity might be headed next.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.